But here's the biggest kicker and why I put this chart together. We've had 7 rate cuts from 5% all the way down to here. But do you see where sales are? They're still bottom out right here. Yes, we got a tiny little uptick over here, and that's because of seasonality, but it's still very, very low right now. So to say that the Bank of Canada is going to cut the rates a little bit more and see that sales come up this way may be true in a very, very small seasonal amount, which I'm going to show you shortly. But it's not to say that sales are going to go all the way back up to over here when we get a 10,000 sales. That's just not going to happen. So what this may indicate is that sales, the number of transactions may have bottomed, but it doesn't mean that prices have bottomed. Prices may continue trending down because we have a lot of inventory, which I'll show you a little bit later. Canada's economy just broke. GDP is now officially negative. 66,000 jobs were lost in August, and the unemployment rate is back at pandemic level highs. The Bank of Canada has no choice. Rate cuts are coming at some time. But here's the thing, cuts are not a sign of strength. They're a sign of how bad things really are right now in the economy. So in this episode, I'm gonna break down what this means for you, whether you're buying or selling or investing in the Toronto real estate market. Hi, my name is Zen, and if you enjoy my data-driven and number-crunching real estate updates, be sure to like and subscribe. Is the Bank of Canada's rate cut in the bag on September 17th, given the creating job market? And the first thing I will note is Bank of Canada's mandate isn't necessarily about jobs. It's more about inflation and the stability of it. Of course, a bunch of weird things will happen, but when we're looking at this article, we're saying that we lost 66,000 jobs. That's really, really bad. It's the highest since pandemic levels. And do keep in mind, 7.1% is all of Canada. If I were to look at just Toronto, you can see that the unemployment rate is actually at 9.2%. So it's actually much higher than what the national average is. And when we look at this chart over here, you can see that the 9.2% is right over here. So for us to get back to 9.2%, basically it's at the pandemic levels, which if you remember, not great for job market. But to go back to when we saw 9.2% in Toronto, we basically have to go back to 2012 and 2010. So to say that the job market is bad, it's a little bit understating it. The other thing we have to keep in mind of is the annual change in private payroll. So this is when you remove out, call it government workers. And you can kind of see right here that we are trending negative. It was high at some point where we're adding a lot of jobs, but right now we are below 0, which means that we're losing a lot of jobs in the private sector, which means that businesses are not hiring, businesses are cutting, which aligns with what everyone is hearing. Big companies are cutting jobs right now to meet the bottom line. Then when you layer this on top of the how many people are actually unemployed and looking for work for more than 27 weeks, and in layman terms, what that basically means is how many people are looking for a job after they've been laid off and they've been looking for more than half a year. And that percentage is increasing and it's really high right now. It's at 1.5%, which basically tells you that, hey, if you've lost your job, finding another job is very, very hard right now. And to get to a point where we're at this level, we have to, again, go all the way back, if not even a little bit more, to the great financial crisis, if we take out the pandemic. So to say that the job market is weak right now is kind of an understatement. We're seeing all the indicators and trend lines go the wrong direction, which means that the labor force market is likely to see continued weakness. Now, the next thing that came up that's also important is that we finally got the second quarter GDP and it shrank by 1.6%, meaning it fell by 1.6%. Remember, negative GDP growth 2 quarters back to back is a technical recession. But the magnitude and the severity of the recession and how bad it is really depends on how much the GDP shrinks by, which I'll get into more later. But right now, we're seeing the first quarter of negative growth. And when we look at the composition of what caused the GDP to shrink down, you can see over here that a lot of that came from net trade, which is caused by the tariff. And you see businesses are dropping right now. So could this, to use the word transitory? Potentially. We don't know where the trade wars and the tariffs are going to ultimately end up. They may fix itself, but even if they stay, it is technically a one-time shock. So we may not see such a drastic drop in net trade for the next quarter. But again, there's too many things up in the air right now. But ultimately, that just means that the economy is shrinking right now. Now, this chart here is the Canadian GDP growth annualized on a quarterly basis. So you can see this is the minus 1.6% print that we just got. You can see over here that things were decent, not great, but we had some shock factors here depending on how you calculate it. And even though we have a pretty sizable negative print here, again, this doesn't mean that the next quarter may not be positive because, again, tariffs could be just a transitory thing because it's a one-time shock. Because we got this in 2023 and also in 2023 earlier as well. So to say that we may be in a technical recession and that the market's going to collapse, it's a little bit of a stretch only because things could change in the next quarter. But either way, this may be another signal for the Bank of Canada to make a cut on September 17th. Hey, it's me interrupting myself. Ready to make a move? Just one free call, no hassle, but decades of experience to work for you. And finally, the thing that the Bank of Canada actually is watching the most, our latest inflation print actually said that we fell to 1.7%. So this is actually a good sign. So when we look at the inflation data, generally the Bank of Canada wants things to hover around 1 and 3%, which is this band that I'm drawing for you right now. And you can see that we are right now at 1.7%. So we're well within that band. And what this means for you as a consumer is that if the inflation is too high, the Bank of Canada is unlikely to cut rates because it's going to stimulate the economy. But right now with inflation within that band, they have wiggle room to make that cut. But at the end of the day, whether they make the cut or not, I really think just depends on what the US is going to do. And just ironically in September, both the Bank of Canada and the Federal Reserve, which is the US Bank of Canada equivalent, is making the announcement on the 17th. And they're likely going to talk. So my thinking is that Canada will probably follow US and whatever US does. So there are three reasons now why the Bank of Canada can't actually cut rates. You have your weak GDP, job losses, and a stable inflation by this metric. However, what I'm going to show you now may not be what you want to hear if you're a real estate owner. When the Bank of Canada actually cuts their overnight rate, it actually doesn't move the needle for the Toronto real estate market. And you can see this in the past little bit. So I've put this chart together because in the last year, as I've been talking to a lot of people who are selling, the narrative and the sentiment that rate cuts are going to stimulate the real estate market and make things kind of like pop again like it was in 2021 has been a narrative that the sellers have been believing, and it gives them hope that, hey, whenever we have more rate cuts, it's going to get better and better. However, if you were to sell a property at the start of the year, it's a much better market condition than it is right now. So the longer you wait, if you're a seller, you may actually see lower and lower prices. And this is why I put this chart together, because the Bank of Canada's overnight rate only affects the variable mortgage. And I'm going to show you exactly what has happened with the rates and the number of sales, not the price, because that's a lagging indicator. And let me show you how to read this chart. So the blue line over here matches the y-axis over here for the amount of sales. So this is the amount of home sales in the GTA. And then your orange line over here, which matches this y-axis, is the Bank of Canada's overnight rate. And generally speaking, your variable is like 1% higher than whatever the rate is. So you can see the orange line is the Bank of Canada's overnight rate, whether they increase it or decrease it. So if I bring you all the way back to the start of 2022 in Q1, sales were literally through the roof. We were at 11,000 in February. That was the peak of the market. And you can see that the rates were basically at zero. It was like 0.25%. And as we saw the rate increase from 0% all the way to 4.5, you can see that the sales plummeted from 11,000 all the way down to 4,000. So that's a really, really big plummet. And that's the correlation that generally you see when rates go up, sales come down, which by general correlation means that prices should be coming down. And that's the thinking that most sellers that I've been speaking to have in mind, which was correct, but it's not going to be correct forever. Because when you see over here, you can see over here that the rate remained flat. If anything, they actually went up a little bit. But you can see over here in 2023, in the spring, sales went up. And this is to indicate to you one data point that Bank of Canada's rate announcement doesn't affect the number of sales or the prices, because what happened in the spring of 2023 was Silicon Valley Bank collapsed and the fixed rate went down to 4% instead of the variable rate being around 5 to 6, which basically spurred a large increase in sales and prices, one of the largest increases in spring that we ever saw. But then shortly after, you can see that Bank of Canada increased the rates again, and this is where it dropped the sentiment and sales plummeted all the way back down to 4,000. And this amount of sales is very, very little. But here's the biggest kicker and why I put this chart together. We've had 7 rate cuts from 5% all the way down to here. But do you see where sales are? They're still bottom out right here. Yes, we got a tiny little uptick over here, and that's because of seasonality, but it's still very, very low right now. So to say that the Bank of Canada is going to cut the rates a little bit more and see that sales come up this way may be true in a very, very small seasonal amount, which I'm going to show you shortly. But it's not to say that sales are going to go all the way back up to over here when we get a 10,000 sales. That's just not going to happen. So what this may indicate is that sales, the number of transactions may have bottomed, but it doesn't mean that prices have bottomed. Prices may continue trending down because we have a lot of inventory, which I'll show you a little bit later. And when you look at this chart over here, the reason why you may have seen the bottom for sales, again, the bottom being like 25-year decade low. So we move up from that because I've shown you in the last video that in August, yes, we're no longer at the bottom, but we're only like a few hundred sales more than the previous year. So we're increasing by a tiny little bit. And this data that points to the bottom is that our population is so large right now, and the number of sales per population is so low that it brings us to the 1990s level before GTA has doubled its population, and the stock of housing has actually more than doubled. So to have this little sales is to show that the sentiment's really weak. So for us to say that, hey, sales have bottomed, maybe we just go back up to like over here. That doesn't make the market any stronger or make prices go up. It just means that, hey, we have seen the least amount of sales for the last little bit. So the reason why I put all these charts and data together is to show you how some of the things have behaved in the past. And just because it happened in the past doesn't mean it's going to happen again in the future. Because what I'm going to show you right now is how a recession from a GDP perspective has affected real estate prices. So the chart you're looking at right now is the Canada quarterly GDP, but I did remove the pandemic line, which would be over here because that would be like literally things off the chart. So I want to show you what has happened of real estate prices and also show you the inventory and how many quarters of GDP decline there actually were in these periods where we saw a technical recession. So going all the way back to 2000s, the first one you'll remember is the Great Financial Crisis, which is over here. So we had 3 quarters of GDP decline and prices actually went up 10% towards the end of it. And a lot of that had to do with the fact that interest rates got pinned to the floor, but Canada was not affected by the Great Financial Crisis as much as the US. And you can see over here, we had 12,000 active listings. So these are data points you should keep in mind of that I think are important. Then you had the second technical recession, which was the oil crash. And this happened in the second quarter and the first quarter of 2015. A lot of it had to do with Alberta, but you can see that prices went up 15% in Toronto real estate. Keeping in mind, the oil price crash affected the prairies and Alberta a lot more than it affected Ontario. And you can see that the active listings at the end of that technical recession was about 15,000. Now, I'm not going to talk about what happened during COVID because everyone knows what happened. Things just like blew up. We had no supply. And now we have the rate shock technical recession where it only really shows up if you don't annualize the GDP because they keep fudging the numbers. But effectively, you had 2 quarters of GDP decline and you had average price increase by 2.3%, and your inventory is still even higher at 19%. But you can see that in every single technical recession that we saw in the last 2 decades, prices went up. But what I didn't show you here is that the quarters before the announcement of the technical recession, prices actually went down. So this increase of, call it 10%, increase of 15%, and increase of 2%, prices actually went down a few quarters before because you have to remember, GDP numbers is a lagging indicator. We are just getting our second quarter GDP report where it already happened in April, May, June. It's almost 6 months behind. That's how slow this data is, and the market moves a lot faster to it. Now, I say this not because, hey, we are entering a potential technical recession right now with the first GDP print that's negative and we may see prices go up. That's not what I'm saying right now. What I'm actually trying to illustrate is that every single time we had a technical recession for whatever reason and rate cuts do happen, it doesn't necessarily mean that the market is going to move a certain direction. Every single time I've shown you of a technical recession right now in this chart has had a different impact on the real estate market. And when I boil everything down to the most simplest way to explain the real estate market, because all of this, if you ask me, is way too technical to explain to 90% of the people who are buying, selling, and investing in the Toronto real estate market. But when I boil things down, it's not that rate cuts mean prices up. No, not at all. It's that inventory drives how much prices are going to increase or decrease. Right now, you can see that the inventory in the Great Financial Crisis was at 12,000. Then it got a little bit higher at 15,000. And then 2023 is at 19,000. We're at 27,000 25,000 right now. It was as high as 30,000. And this is what I was saying in my last video when I gave the market watch, that we haven't seen an inventory this high. And we're likely going to see inventory spike at the end of September, which basically means that we should not be seeing prices increase because the inventory is so high. Buyers have so much choice. Because if we have another quarter print, which we were not going to get until 2026, and even if it is negative, the rate cuts would have happened. It may actually stimulate the market a little bit where sales, again, like I was saying, have bottomed and they will increase. But that doesn't mean prices are going to increase, because we need to see inventory really low and getting back to, call it, your 15, 16,000 for prices to actually increase. Because you have to remember, the 2022 price shock made prices fall down 18%, even though it recovered 2% in those 2 quarters. So to show you as a whole picture, prices may zig up and down, but ultimately they're trending downwards unless the inventory clears up. That is the most important thing and the simplest way to explain where the market's going. Until we see the active listings go from 27,000 down to around this range at 15,000, I do not see prices moving up anytime soon. So we have a lot of catch up to do in sales to remove a lot of this inventory. And that is the simplest way to explain where the real estate market is heading in the next 3 months. Now, in case you missed my lengthier explanation of the latest stats that came out and how inventory is going to be spiking in this direction in September, make sure to check out the video that's on the screen right here to understand the entire story of where the real estate market is heading. I'll see you in the next video. Until next time, your move, your future. See ya.